Hey guys. So I have about half a dozen people that I'm helping right now, coaching them through buying their first investment property. And one of the biggest sources of confusion and one of the things that I get the most questions about is investment loans. And when I was first learning all this stuff, that was probably the single biggest thing that I had to learn to be able to do this. So I'm going to kind of give you a brief overview of the different loan products and then kind of explain the pros and cons of each and try to do it in 10 minutes or less. So I'm going to go fast here. So the first one is the FHA loan. So an FHA loan is kind of your typical first-time home buyer's loan. With that loan, you only have to put 3.5% down payment plus your closing costs, obviously. And that is a conforming government-backed loan. So when you hear Fannie Mae, Freddie Mac backed loan, and FHA loan is one of those products. And one of the other things with the FHA is you are required to be an owner occupant, and that means that you have to live in that property for the better part of a year to be able to qualify for that loan. Now, one of the great things about the FHA loan is that that does not have to be a single family property. So any residential property, now residential is defined as anything from a 1 up to a 4 units. You can actually buy a fourplex with an FHA loan and only put 3.5% down. Now that's great because with a fourplex you can basically rent out three of the units, live in one yourself, and with the FHA program they will actually use the additional income from those three rented out units. I think it's 75% of that. They will actually count that towards your income for qualifying for those loans. So if you're just getting started, I would say the multifamily FHA loan is probably one of the best things that you can do. So that's the FHA loan. The second type is what I would call a conforming or conventional loan. That is also a government-backed loan, so also backed by Fannie Mae, Freddie Mac. And with that type of loan, the bank is actually acting as basically a broker. So they will put the loan together. They have Fannie Mae, Freddie Mac guidelines that they have to follow. They package that all up, and a lot of times you'll hear them call it a secondary market loan. So they will basically sell that loan off to somebody else, and they will not keep it on their books. So it has to meet all of those guidelines. Now with a conventional loan, I believe there's programs where you can get down to 5% as an owner-occupant. But if you are a investor only, so you're buying this property not to live in it, but as a pure investment, you're pretty much always going to have to put 20% down. That's just kind of a requirement of those loans. Now, one of the other things with the conventional loan is there are seasoning requirements. So I've told you guys before, my strategy is to buy a property with a short-term loan, buy a distressed property, fix it up, and then I'm going to refinance based on what the appraised value of that property is. So when there's a seasoning requirement or title seasoning with a conventional loan, typically that is anywhere from 6 months to a year. So that means I have to wait from the time that I close on that property with the first loan. I have to wait either 6 months or a year, depending on the bank, before I can refinance and get my money back out to use again. So that's the conventional loan. Now the next one is a non-conforming loan. So a non-conforming loan, often called a portfolio loan, now that is one that the lender is actually going to keep in-house. So when I go conventional, I can get the the government-backed rate. So I might be right now with a conventional, I'd probably be somewhere in the 4.5% interest rate, and I can get a 30-year fixed loan. And I can get up to 10 of those conforming loans. Anything over 10, I'm no longer allowed to have the conventional loan. I've got to go to a different type of product. And the non-conforming loans, those are actually going to be held on the bank's books. So when you hear them called a portfolio loan, what that means is the bank is actually keeping that loan, in-house. So the benefits of a non-conforming or a portfolio loan is there's a lot less restrictions on what you can do. The lending guidelines are not as strict, but you're definitely going to pay for that in interest rate and terms. So where I can get 4.5 with a conventional, on these portfolio loans, I'm probably looking more like 5.5 to 6% interest rates. And often there's a lot of other, there's balloon periods sometimes. The amortization is not going to be as long. So typically 25 years is what you're looking at for conventional loans. Sometimes you can get 25. Some of them have balloon features where they balloon in 10. And a lot of times there's adjustable rates as well. So with the loan products that I'm using right now, I'm doing what's called a 5-year ARM. And what that means is I basically have a 5-year fixed period. I'm on a 20-year amortization, so it's amortized over 20 years. But then after that 5-year period, it can adjust. And the way that they figure in what the rate is they basically take that prime rate, and it's prime plus 1 or 2 points, or however they figure it, and it's going to adjust after that 5-year period. Now with my loans, I have a cap on mine, so I know that my loans can only go up to 10%, which is kind of the worst case scenario, and that is absolutely a risk that as an investor you need to understand. So when I'm running the numbers on my properties, I will look, okay, if this interest rate goes, all the way to 10 and caps out, what is that going to do to my properties? How's that going to affect their performance? And, my investing model is I buy kind of low priced, high cash flow type properties. So on those type of properties, that interest rate risk is much lower. And, at 10%, I can still cash flow those properties and do just fine. Now, if you have a more expensive property, so say you have a $100,000, $150,000, $200,000 investment property, and you're only, netting a couple $100 a month, that might be the difference between you going into a negative cash flow situation. So that is something that you need to understand and think about when you're investing. So that is the portfolio loan. One more loan product that you'll hear thrown around in the investing world a lot is what's called a hard money loan. So a hard money loan is a loan where basically the property itself is the only collateral. So on those other loans, chances are you're going to sign a personal guarantee. That means you're basically on the hook guaranteeing that loan. With a hard money loan, the property itself is the only collateral. So that means if if you stop making your payments, something goes wrong, they can basically foreclose on you, take that property back, but it's not going to affect your credit, and you can basically walk away from that property. Now with a hard money loan, you're typically going to be paying much higher interest rates. I mean, hard money loans can be as high as 15 to 16%, and you're also going to pay points up front, so like up to 5-6 points. And if you don't know what points are, so a point is basically a flat percentage of the rate. So say I have a $100,000 loan, 2 points, that would be 2% of the loan value, or $2,000. So that's the hard money loan. And then there's one final loan product, which is called a non-recourse loan. And a non-recourse loan is kind of a cross between the hard money loan and a non-conforming loan. And that also is a loan where you have no personal guarantee. The property itself is the only collateral, but that is like a commercial longer-term loan product. So a lot of times when you see the bigger guys, the guys that are buying, 50, 100 unit apartment complexes, there comes a period, you get big enough where a personal guarantee at some point really isn't going to matter that much. Just the property itself, that's going to pay the mortgage. So, if you have a property where the debt service on that property is $20,000 a month, that's not going to come out of your salary. If the whole thing goes vacant, it's going to be coming from the tenants. So non-recourse loan is another type of loan. And with the non-recourse products, they are also probably going to be looking for a little bit higher down payment. So typically at least 25%. And a lot of times that's on kind of the higher dollar value, $1 million plus loans. So, I think that's pretty much a general overview of the loan product. So I hope you found that helpful. Definitely do more research. This is just kind of to give you a basic understanding, but if you Google any of these terms I used, there's lots of stuff online. Get on Bigger Pockets, lots of books on this stuff too. So hope you guys enjoyed it. Thanks.